very well spread out market, given the fact that the rally is only continuing, fifth straight day of gains coming in for the markets. And if you go by it, it could be could be headed for the biggest 5-day rally since early 2021. But what the setup is looking like, and what should one do while talking about strategizing their portfolio? We have Deepak Shenoy joining us right now. Very good afternoon to you, Deepak. Thank you so much for joining us. And the key question being is that will this rally sustain going ahead? This is the time to celebrate, or do you think that it's just a 90-day pause coming in on those tariffs, so just take it easy?
Well, to be fair, we can't say anything right now because every day there's a new, piece of information that comes in from the US or from other countries. But I think by and large, the world has come to some kind of an intermediate level thought process that it's going to be difficult for the US to impose the kind of tariffs that they've initially thought of. But perhaps a 10% tariff is more or less likely across the board. Perhaps a little more for China, given, and they're already anyway more, about 20%, I think, anyways. So there is a differential there, but there is also the fact that much of this is not going to be as dramatically changing for the world trade as it used to be earlier. And there are some positive signs for India as a country, specifically because we are not so clued into the international trade scene. I don't think we should think of ourselves as we'll try to replace China. We're way, way behind. We are not going to be able to meaningfully do anything in that respect. But because we are a relatively domestic-oriented economy, there is a large domestic market. A lot of our companies serve our domestic market, whether it is from consumption, from even a manufacturing or an infrastructure basis. There is a lot of stocks that might actually benefit if India continues on its journey, and it has a lot of momentum behind it. So I feel here that internationally we will see a lot more volatility, but domestic market from an economic perspective may still be okay. A lot of our markets depend on fund flows. If FIIs keep coming as strongly as they've been coming in the last few weeks, last week, in fact, last 1 week or so, then I think the markets are likely to go, northwards more than down. So there is a lot of that factors in. Economically, I think longer term we're still okay.
Good afternoon and congratulations. Firstly, Capital Mind Mutual Fund has finally got the regulator nod. So tell me, what's the investment rationale going to be like, given that there are so many uncertainties out there in the markets?
In fact, Aisha, thanks so much. Firstly, we already at the parent level run PMS, so we've been managing funds already, but hopefully at the retail level we'll be able to do more for more people. But I think overall the rationale, in general in India, the markets are going to give you significant returns over a long term, compared to perhaps most other instruments. In fact, some of the better ways to participate, even in debt or in a hybrid kind of a situation where you want a combination of equity and debt, tends to be a mutual fund. So that's one of those things that is attracting us, is that we can offer more to investors. And I think in the longer term, equity should give you great returns, as it has in the last 30, but also because we're a growing economy. And we're probably going into the phase where we're going past this $2,000 per capita, probably going towards a $5,000 to $10,000 per capita in the next 20 years. Very excited about how markets will play a role. Our investment rationale, of course, remains, stay quantitative, focus on data, look at a lot of look at a marketplace as a whole rather than just individual companies to make a decision. And also at the micro level, opportunities will spring up in certain individual companies where we will definitely want to take a look, and that may be either in the debt markets or in the equity markets or in some quasi debt or quasi equity instruments as well. So excited about the opportunity. I think unfortunately we can't have a different investment rationale than everybody else. We're very bullish on India in the long term.
Yeah, you've got to be. But given the point that you made, Deepak, about the per capita income rising, the first port of call that comes to your mind is consumption. While the means and mediums of consumption may change, but that's going to be the first go-to. How are you looking at that space right now? Because while in India it's still a very narrow market, the large pool is still very much the staples.
It's a very interesting thing, Aisha. In fact, if you look at the top, maybe 15% of households, which perhaps form most of the middle and upper middle class that you might see in this country, that's about 20 crore people. 20 crore is bigger than the size of most European countries. And we have a much higher per capita there than we have in the rest of the country, right? So you have consumption which takes different formats. In India, consumption used to be equated with FMCG. But my point is, how much more toothpaste will you buy? It's not really a Indian consumption thing anymore. What was called consumption in the last 20 years was soaps and toothpaste and toothbrushes. But the next 20 years is going to be more about travel, tourism, consumption of higher brand goods, the coffee chains, the restaurant chains. I think all of this is going to contribute to consumption, including experiences in the tourism areas, in other aspects of these things, and the technology, the players in the back end that will actually, kind of power this stuff as well. I think that is the new consumption story that we're talking about. It may not necessarily be only the premium players, like you might have premium clothing brands and all that stuff, but I think it's also across the board, whether it is instant home delivery, startups or companies that are listed that go into this space. I think consumption now goes across this part of the ecosystem. I would say here, you don't necessarily mean that India's consumption will go up, meaning all these companies will do well. Because if you have 5 medical shops on a street where you had only one medical shop, the consumption of medicines can go up, but it is distributed across 5 shops. So not each shop will actually have a lesser profit. That's what's happening to much of the consumption space now. There's so much more companies coming here to serve you that every one of them is getting a slightly smaller market share, but the market overall is growing. So I'm very positive on consumption. I can't say that any one consumption player will come out and become a clear winner. And we're seeing this in the paint space, though it's not really consumption. But, one company or 2 companies owned the roost there. And now you're seeing that, more companies are coming in and they're breaking into it. India may still be using more paints, but not one paint. The one paint player may not see as much in terms of profitability growth as they used to see earlier.
A healthy day coming in for the markets, given the fact that you have Nifty surpassing that 24,100 mark, Nifty Bank hitting all-time high levels, and the likes of HDFC Bank, ICICI Bank, all of them hovering around that 52-week high levels. Kunal, but the key question being is, do you think that the outperformance by the banks will sustain going ahead now?
So I think at some point of time it should moderate after this 5,000 point rally. But then I think this tells you that this is the leading sector. And this is why I think over the last 1 week, 3 months or so, Bank Nifty and the banking stocks were outperforming. It's very difficult to now catch these banking stocks at current levels for someone who's missed out in this maybe this last 5,000 point rally for the banking index. So maybe I think you'll have to probably make good with the tier 2 performing names or the bit of underperformers in this leg. But I strongly believe that these are kind of leadership moves or leadership breakouts which happen within sectors and across sectors for markets. And these kind of moves, they generally unfold itself into multi-month, multi-quarter upticks for many of the sectors. And in this case, we're looking at a formidable heavyweight sector from the Nifty 50 also. So I think I would probably expect many of these banking stocks to do extremely well from here on to say the next 1 month, 3 month or 6 month perspective. And my expectation is that the likes of ICICI Bank, which has been an underperformer today, HDFC Bank, Kotak Bank, even the likes of Axis, IndusInd Bank, I think they should start continuing this momentum much more ferociously even from current levels.
Deepak, I want to get your thoughts in on banks. I don't think the debate is really about the creme private banking names, but it's more about whether you go now down the rung and do you add more positions to your existing banking portfolio.
So, Aisha, I think the banking sector in general has had two issues. One is that credit growth has not been good at all. About 10%, 11%, even recently, as I think there's only about 10.5% credit growth, 10.5% deposit growth. Deposits won't grow unless you grow credit. So as a banking system in general, we're not growing, meaningfully fast enough for banks to grow, to kind of justify the valuations that they've been at in the past. And definitely, I mean, it's still probably debatable about now, but also they have had healthier balance sheets. So their credit, it's not the lack of willingness to lend is not based on their capital availability. Their capital buffers are quite strong. Secondly, of course, it's been the turmoil in general worldwide that has caused or restrained people from expanding operations, from taking on corporate capex, and a meaningful slowdown by the RBI, which had kind of sought to say you're growing retail credit too much, so reduce that. So both of these things are kind of behind us, in the sense that now I think as more clarity will flow after all the damage that the US has done in the global economy. I think as things get better, more capex opportunities will come their way. Retail loans wise, the growth has slowed down considerably. RBI has also eased up, and I think there will be a growth back in that portfolio as well. So I think there is these two things that are kind of helping the banking companies help, and we own a bunch of these in the PMS. But the idea here is the stronger banks and the stronger NBFCs will benefit quite a bit. There are some issues still happening with microfinance institutions, with the smaller banks, where the cost of deposits continues to be quite high, and therefore their margins are not as good as the larger banks have. So I think that pushes us more towards looking at the larger banks, whether they're private or public, to fuel themselves in this expansion. The smaller ones will follow, and the risk reward is very different in them. But I think the overall the banking sector should do well in the coming 1 year, 1.5 years at least.
Right, so banking space, that one in the spotlight, hopefully will do well or continue to do well for the next 1 year or so. But remember, the banks have come out with their earnings, a good one at that. You had good performance coming from HDFC Bank as well as ICICI Bank. But apart from the banking space, you have the IT sector also that has been in focus, because players are remaining cautious, especially given the fact that there is global uncertainties around. You have the major IT companies share weak guidance, even as the results have come in mixed. Share this year with the IT roundup.
Well, overall, if we're saying on a long-term basis, there is a question mark coming in that what would be the sustenance numbers going ahead for the IT companies. The muted performance coming in the third quarter from the large cap IT companies. Also, of course, the expectations also for this quarter have been modest. Now, there is no cancellation of orders currently, but there would be a delay in the decision making, and that doesn't augur well for the IT segment. The clients also prioritizing much more on the cost optimization and how the budgets will actually pan out. That is something to watch out for. And importantly, I would also like to point out is the discretionary spends that has remained still soft, and they have been remained soft over the last 1.5 to 2 years, as the client is continuing to focus on cost cutting as well. Interestingly, headcount addition that is low now, and that we could have seen in Infosys numbers as well. The key concern being the continuous delay which is happening because of the spending due to the tariff issues coming in. Now, interestingly, the key highlights are actually looking a bit decent. That is that the healthy deal wins are still there, but the guidance for FY26 that still remains healthy. Now, the IT index performance, they have been significantly underperforming Nifty. Interestingly, post correction, the valuation has become a bit more realistic. The weightages which was there of IT in the Nifty index, that has actually significantly down from almost 18% to 12%. Nifty IT index last 3 months is down 21% as compared to Nifty performance, which is in the green, which is more than 3% right now. And IT sector overall analysis, if you look at it, the numbers over there, main thing is the guidance. The overall the revenue margins, they have been stable as expected, what has come in the overall report card. But the main thing is the revenue guidance, especially for FY26 Q1, that has not been encouraging. The valuations after corrections, they are looking attractive. Perhaps that might be the reason of some buying in day's trade today. Wipro That's the numbers are coming almost, you could say, below that 5-year averages in Infosys and TCS as well. So it'll be very interesting to get to know about other IT companies also as they come out with their results this week.
All right. That's the take coming in on IT and how some of these big boys actually stack up so far. But Deepak, the bottom multiples for, the tier 1 companies are already at, their 10-year average. The stocks, of course, would bottom out historically as they do before earnings turn tide. Do you think that's the time now?
It's a good question. In fact, I think, the problem with IT is what do you do if your customers are probably wondering what the next big move is and whether they should invest. If you're a large US company today, are you considering expanding your operations? Where will you expand your operations? What will you do? You don't know, because if you expand operations in the US and America makes a deal with China on tariffs, then your expansion is hosed because you don't want that to come in at some point. But at the same time, you don't know whether the tariffs are going to stay, they're going to increase. So everybody's on this wait and watch mode until they get into something bigger. So revenue growth opportunities in these companies is going to be limited and muted to the extent that people are going to see hits on profitability, people are going to see hits on their margins, their customers, that is. Therefore, they're not going to meaningfully want to expand their IT outsourcing. However, I do see one change because of the change in visa approach in the US. When work has to be done, more work will be done in India, that is offshore from the US, than it is done on site, simply because availability relatively still remains lower in the US. So there's going to be more work done outside of the US, even for US companies. And services tariffs have not even been talked about or introduced. So I don't think they will be. Plus, America is one of the world's largest exporter of tariffs by a huge margin. And therefore, I don't think the US will want meaningful, retaliation on service tariffs. So I don't think they will go there. So that these two things remain in their benefit. I would say still wait and watch. Just don't jump in just now because you don't know what's going to change. And when there's more clarity, the prices tend to go up when the markets go up. But I think clarity in the economic growth is what's going to drive future valuations in the IT sector. I would say they're fairly valued right now. So I don't think there's a huge, sell everything else and buy IT. But if it comes to that point, that may be a different thing. But right now, I would still say just wait and watch. Let the market get more clarity for you before you invest.
All right, so that's the check coming in on the IT space. On that note, thank you so much, Deepak, for joining us on the show and giving us your take. And also, congratulations to you and your team at Capital.